The Japanese yen, once a bedrock of stability in global finance, is now sending alarm bells across economies worldwide. As of mid-2025, the yen has weakened to levels not seen in decades, trading near 146 to the US dollar. What does such a steep devaluation mean, not just for Japan, but for the global financial system? Is this a temporary turbulence, or a structural warning sign that could disrupt trade, inflation, and monetary policy far beyond Asia? Let's ground our discussion in facts because numbers don't lie. Since early 2023, the yen has depreciated by approximately 20 to 25% against the US dollar, reaching a low of nearly 162 yen in mid-2024. Japan's gross external debt stood at approximately 4.31 trillion US dollars in December 2024, accounting for about 111% of its GDP. The short-term component alone was roughly 3.14 trillion US dollars. Foreign holdings of Japanese government bonds have reportedly declined, though specific figures vary, reflecting waning international demand. Despite relatively stable oil prices in dollar terms, Japan's import costs in yen have surged, especially for energy and food. The Bank of Japan maintained negative interest rates for nearly a decade, only reversing course in early 2024, but 10-year Japanese government bonds yields remain notably below US levels. These data point to structural imbalances and mounting pressures in Japan's economic system. The yen's journey mirrors Japan's broader economic arc. In the 1980s, a strong yen was emblematic of a booming export powerhouse. But the Plaza Accord of 1985, which forced the yen upward, inadvertently contributed to Japan's ensuing lost decades. Since then, the BOJ has battled deflation with persistent monetary easing and negative rates. Despite these efforts, growth has remained stubbornly stagnant. The yen's current slide is not just a fluctuation, it is the accumulated signal of unresolved structural issues, aging demographics, debt overload, and weak domestic demand. The latest collapse in the yen poses a real economic hazard. For import-reliant Japan, weaker yen means imported fuel and food become more expensive, feeding inflation and squeezing consumers. Multinationals suffer too. Foreign earnings translate poorly back into yen, reducing domestic profits. More broadly, when Japan's currency is weak, regional currencies across Asia come under downward pressure, risking competitive devaluations. In every scenario, financial markets sense that something bigger is amiss, not just in Tokyo, but in global capital flows. Here's where we step into the boots of technocrats interpreting the warning signs. Debt dynamics. Japan's ratio of debt to GDP exceeds 250%, the highest among G7 nations. As yields rise abroad, Japanese rates must climb too, or risk capital flight. The question is, can Japan service its debt cost-effectively if global rates remain elevated? Monetary divergence. While the Federal Reserve and ECB have pivoted toward higher rates to fight inflation, the BOJ remains dovish. This divergence risks widening capital flow imbalances and encouraging carry trades, speculative money flows that can reverse suddenly and violently. Trade implications. A weak yen makes Japan competitive in exports, but penalizes energy and essential imports. It shifts the burden onto consumers, reducing purchasing power and altering the composition of inflation, something that central banks elsewhere must monitor closely. Regional contagion. Emerging Asian markets, many with currencies tethered to the dollar, may face indirect pressure. For instance, South Korea or Thailand could experience export cost shocks or capital flight if their currencies weaken relative to a sliding yen. disrupting regional financial stability. This is not just about Japan. It is about how a systemic shock in a major economy can cascade through supply chains, trade flows, and global financial markets. Looking forward, 3 systemic scenarios lie ahead. Baseline scenario. BOJ maintains its ultra-loose policy, while fiscal authorities gradually rein in deficits. Gradual yen stabilization occurs, aided by modest demand recovery and debt refinancing. Japan avoids crisis but remains economically fragile. Stress scenario. Global rates remain high. Foreign investors dump JGBs and yen collapses further, beyond 180 to the dollar. Capital flight accelerates, forcing BOJ to intervene with costly bond purchases and FX market defense. Japan enters a liquidity trap with potential contagion to European and Asian markets. Breakthrough scenario. Japan embarks on bold structural reform. Public debt is restructured. BOJ coordinates rate hikes, and targeted fiscal stimulus reignites growth. Nihon emerges stronger, with yen stabilization achieved through renewed confidence and market credibility rather than intervention. In all scenarios, the critical variable is confidence in policy, governance, and solvency. The real risk is a silent crisis of confidence. If markets no longer view JGBs as safe assets or Japanese institutions as reliable anchors, then the yen's slide could catalyze a broader realignment of global safe haven flows. Flight to dollars may intensify, benefiting U.S. Treasuries while undermining global liquidity and tightening financial conditions worldwide. Japan's yen crisis is no isolated episode, it's a signal. A weak yen reflects domestic structural challenges, shifts in global monetary regimes, and fragile confidence in one of the world's largest economies. The implications ripple across currencies, central banks, and markets everywhere. The critical question: will this be a contained crisis or a prelude to a broader global financial shock? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.